Hello everyone, and thank you for joining this weekly technical analysis video for dollar yen, Aussie dollar and gold. The US markets are enjoying a long weekend celebrating the Independence Day on 4th of July. But after that, the focus will immediately turn to the calendar. A couple of key data releases and events are expected to affect rate expectations in the US, including Friday's nonfarm payrolls report. In Australia, the central bank is expected to announce its next rate decision, while gold will be important to watch as well if rate expectations in the US change. So starting first with dollar yen and the non-farm payrolls report, while expectations point to a slower jobs growth, but investors are probably prepared for another upbeat report given the positive surprises in the US data lately. So another upbeat report and stronger expectations for additional rate hikes in the US could drive dollar yen above the 145 and 145.60 resistance territory where this ascending line is located. We need to break above that bar in order to continue higher to reach the 147.24 level. And that could be an important region to watch given that the pair has closed around this territory back in 1998. So a continuation higher from here could confirm additional gains, likely driving the pair into the 148.80, 150 constraining zone where the pair peaked back at the end of 2022. Now from a technical perspective, the market seems to be trading within an overbought zone. The RSI and the stochastics have been fluctuating above their overbought levels for some time now, so a downside correction would be very surprising. If that happens, we may see the price posing near the 143.70 barrier. While lower than that, it will be interesting to see whether the pair can rebound around this ascending line where the 20-day exponential moving average is located around 142.65. Failure to hold here could press the price towards the previous high of 140.91, while a deeper decline could probably squeeze the price towards the 50-day exponential moving average of 139.60. Not far below that, I believe that the 138.55 and 138 territory could be a stronger support region, given that a couple of key trend lines are passing through this region, including this support trend line coming from the end of March. Now turning to Aussie dollar and the Reserve Bank of Australia, forecast suggests a 25 basis point rate hike on Tuesday. The central bank will need to maintain a hawkish tone in order to boost the Australian dollar higher, but there is some speculation that the central bank could stay on the sidelines, could keep interest rates steady because of the weaker than expected business PMI data, as well as a more uncertain outlook in China, economic outlook in China. So if the central bank delivers a rate hike, I believe that Aussie dollar could extend this recovery perhaps above the 200-day moving average at 0.6690. Then the 20-day moving average, which is also this middle Bollinger Band, could add some pressure into the market around the 38.2% Fibonacci retracement level of this up leg over here at 0.6730. While higher than that, resistance could come around the 23.6% Fibonacci of 0.6795. There is another key crucial obstacle slightly higher around this long-term resistance line coming from the 0.7660 peak registered back in April 2022. We will need to overcome that border in order to become more confident that that the recovery is more sustainable. From a technical perspective, the bias hasn't switched to the bullish side yet, although the stochastics are sloping upwards at the moment. The RSI and the MACD keep fluctuating within the bearish territory, so the pair could remain under pressure, and the the sell-off could worsen if the price closes below this broken descending line and the 61.8% Fibonacci of 4.6625, in which case I expect the next consolidation phase to develop somewhere between 0.6565 and 0.6550. Breaking below that floor, we may see the pair falling towards the 0.6485 constraining zone, where the price rebounded back at the start of June. Another failure here could then bring the 2020 support trend lines in around 0.6385 next into view. And finally, looking at gold, well, the precious metal have been under pressure on the back of rising treasury yields, rising stocks, and higher rate expectations. We can see that gold is maintaining a downward trajectory, remaining below these key resistance trend lines coming from the 2079 record high. There's little evidence that the market could experience a meaningful rebound, although the stochastics are sloping upwards, suggesting oversold conditions. The RSI and the MACD have barely improved. They are still within the bearish area, so that suggests that there is a risk for a downside correction, especially if we close below the 90.07 base, where the price found support last week. If we cross below that floor, then the precious metal could weaken towards the 200-day moving average at 1860, likely meeting this constraining line over here as well. Not far below that, there's another steeper support line seen around 1835, a break of which could then drive the market probably towards the February of 1804. Now, in the event gold breaks above these key descending trend lines at 1930, I believe that it could run up to test the 50-day moving average at 1965. Though for the outlook to switch back to bullish, to see a more optimistic short-term outlook, the price will need to close decisively above this long-term broken support trend line coming from November 2022, that is seen at 1985. If the price successfully overcomes that bar, then I expect a strong rally towards the 2050 critical resistance territory, where the price peaked back in April and May. So that's all for this weekly technical analysis review. Thank you for watching, and wish you have a great week. Bye-bye.